All right, this is our virtual trading game done by and presented by Joseph, Mitch, and David. First off, we're going to talk a little bit about our investment policy statement. So our return objective was we were aiming for a 12% return by utilizing the $100,000 we're given over a rough 3-month period. Our risk objective, we knew that achieving a 12% return in such a short period required taking on high level of risk.
I'll be talking a little bit about asset allocation, key trading strategies, and key transactions that we had throughout the game. So our original asset allocation was mostly in highly leveraged ETFs because our goal was to make short-term gains, and we were pretty aggressive. We wanted about 10 to 12%, and we knew we only had a couple months to do that. So that's why we decided to do that. And our idea was once we hit our goal of 12% that we would just reinvest in bonds and just let that ride till the end. We did this for a time and we saw good results, but we saw others having better returns as we were invested in the bonds. It kind of got to us. And we just also, it felt like we weren't really playing the game as intended. So we decided to sell everything, sell all the bonds and go back into the market. So we bought stocks that had historically been performing really well. And we lost a lot of money doing so. We lost a lot of money. We tried to salvage and hedge a further market downturn by investing in both a leveraged S&P 500 ETF and a leveraged gold ETF to try to protect us from any further downturns. And then for key trading strategies, we mostly focused on tech-focused ETFs. This made us most of our gains at first. The tech industry at the time was carrying a lot of momentum, and we wanted to capitalize on this momentum. So we rode this swing for a while until we got greedy and invested in individual tech companies, hoping for a greater overall return. And we lost a lot of money on these individual small cap companies. This hurt us deeply. And the market was overall very down during this period. After a bad week, we decided to change to that gold ETF and S&P ETF portfolio to try and recover and hedge from a further market downturn. This so far has not produced the best returns, but we have not been losing as we were before. And some of the key transactions the biggest one happened on October 8th. We were up 12.7% and we had reached our goal. And this is just after we had decided to sell our bonds, and we invested in Western Digital, AMT, and Peloton. And we made really good gains really quickly in those first couple of days. But shortly after, we lost 22% in a day. And that put us at 90% of our total starting portfolio. This was our biggest loss by far. And it came right after we made our biggest short-term wins out of those individual tech companies and the leveraged ETFs that we had previously. Some of I guess our biggest winner would probably be, or it was our leveraged QQQ. That did us a lot of good. That helped us out a lot in the beginning until we got greedy and decided to try to buy individual companies.
Thank you, Mitch. We're going to now look at our portfolio KPI, starting with our holding period return of 1.21. It's not extremely impressive, but does show growth in the short term. For our effective annual return of 5.39%, that's below par for what you might see in the stock market as a whole, which is about 7 to 10%. It's all right, but not extremely impressive. And then moving on to our risk and return and standard deviation, this 48.23% shows extreme volatility. And this is definitely due to our risky investments and our day trading. Moving on to our Sharpe ratio and trainer ratio. Both of these values are extremely negative and show that we are definitely not getting the return that we should be expecting for each unit of risk that we are taking on. Um, Again, with the extreme volatility, this is what we're experiencing. Finally, our portfolio beta is currently 0.995. And this makes sense because we have heavy weight into the S&P 500, which is the market, which will have market beta of 1, so it's going to be very close to that. Here's a look at our portfolio performance versus the benchmark portfolio. Much of this has been covered by Mitch and this is just a visual of kind of the story um, of our portfolio's performance. You can see that huge 22% dip that we experienced after we got greedy versus the benchmark portfolio, which up until recently has been doing generally well.
Finally, the moment we've all been waiting for, our key takeaways from this game. What did Joe, Mitch, and David learn during this last semester of this game? First, well, we learned that you need to follow your plan. Many smart investors, or I would say all smart investors, they tell you that you need to have a plan in place and you need to be disciplined to stick to that plan and not become an emotional investor. Emotional investing obviously causes people to lose lots of money, and we got emotional while investing. We didn't stick to our plan, and our lack of discipline in the end ended up costing us thousands of dollars. Now, another takeaways was that balancing your portfolio is necessary. It's not exciting. It can be boring, but it is necessary. A portfolio that is balanced correctly helps you protect your assets against the validity of the market. Now, this quote we found to be super true. It's be fearful when others are greedy. Now, like I talked about, we strayed from our plan. And we strayed from our plan because we saw a lot of other people in the classroom getting great returns, incredible returns, right? And we wanted what they had, and so we jumped over to where they were at. We got greedy, right? And it cost us. We ended up losing thousands of dollars from that, and really hurt us in the long run. Now, some more key takeaways is that your risk tolerance should reflect liquidity needs. Now, in our example, we had $100,000 to just play with, but let's say I was a college student and I had $1,000 and I needed to get a return on it, but I needed it back in 3 months. In that scenario, if I know I need this $1,000 in 3 months, high risk investing probably isn't my go-to. I'm going to need something that's lower risk, making sure that I'll actually have that money that I need when I need it, and not losing that money. Don't try to time the market. Market timing is extremely difficult, and for new investors, and honestly most investors, it almost never works in their favor. Now, the last, and maybe the most important, is that value-based investing stands the test of time. What do I mean by that? I mean that successful investing comes from focusing on a company's true value, not just the excitement or hype surrounding it. Yes, people make money off of investing in fad stocks or meme stocks, right? But it's not surefire. It's not going to work long term. So taking a company, looking at its value, and investing off of that value, that is the key. That is what will stand the test of time. Thank you very much. We are grateful for what we have gotten to do with this game and what we've learned.